All right. Well, good afternoon. I'm here with my good friend Russ Kellites. Russ is out in beautiful San Francisco. Is it beautiful, Russ? I see a lot of sunshine behind you
Yeah,
there, which is
it is
great news.
beautiful. The sun is trying to poke its head through the clouds, but we've actually had a little bit of rare rain over the last
Oh
couple
boy.
of days.
Well,
Yeah,
send it our way. We've got nothing in Omaha. It's quite balmy.
I'll do,
But let's
I'll
jump
do what I
into
can.
the word of the day: volatility. All right. So it looks like the market is up at least at least by way of the S&P 500. Yet the VIX is at this crazy low number, at least historically low number. Like, what gives? What are you seeing in terms of volatility, and how is it kind of shaping the way you're thinking about investing today?
Well, that's great, John. We like volatility. We like the current environment. I think, as you know, we saw kind of a difficult period last year where the market was coming down, but usually we see an inverse relationship, a dramatic inverse relationship between what volatility is doing, and we tend to look at the VIX as a gauge for volatility and what the market is doing. And we just weren't really seeing that inverse relationship last year, and this year it seems to be really kind of playing out the way we would expect it, which is good for us. But we like the space. We think it's a huge asset class, and yet it's one that very few investors participate in, at least directly. Most, if not all, investors participate in volatility to some degree indirectly, but they don't really segregate out volatility specifically and take advantage of that. And I think that's an interesting area where our fund can come in and help diversify a portfolio really effectively.
Well, I've heard it's described as volatility as the fear index. So, how can fear be good for an investor? And then I'm going to ask you the follow up, well, how can it be bad for investors? So, how is volatility, how can it help an investor? How can it help a portfolio?
Well, it can help in that, there are really kind of two sides to it. There's a point where the market is really complacent justifiably. And so it's a great opportunity to take advantage of this asset class, pick up some economics as, volatility is low, continues to be low, goes lower. And you can take advantage of this kind of fairly low risk way to pick up some economics. But the flip side of that, which is also really important, is that when the market does experience turmoil, it can be a great way to hedge. In fact, it's really a unique way to hedge in that you may recall back in, say, March of 2018, when the markets were selling off really dramatically, many investors just thought, well, we can hedge by selling short the market. There's no reason why we can't just sell S&P futures or NASDAQ or whatever it is you're participating in, and shorten up exposure that way. Well, the problem with that is that there are stops in the market. And so what you'll see is, particularly over the weekend, if the market's selling off from Friday to Monday, the market will actually just put in a stop limit, and you won't be able to go short the S&P as you normally would. And so you're kind of stuck with this difficult portfolio position that you can't hedge. The interesting thing about all that was that the VIX markets were open round the clock. So we literally saw a point where we had this inverse correlation that you'd normally expect to see, where the market's going down, the VIX gauge is, the VIX index, VIX futures are going up, and it's a very measured relationship until the S&P would hit its stop loss, stop trading, and then the VIX futures would just take off, because it was literally one of the few asset classes that you could use to hedge your portfolio. And so the nice thing about that circumstance for us was that our indicators picked up that relationship and how it was playing out. And so we were able to go along the VIX futures going into those periods. And so as the S&P stopped trading, the VIX futures would continue to trade. They'd go up. We were long those positions, and our economics would just dramatically accelerate. So
Times
again,
where everybody's hedging, that these hedges can get expensive, and then there's other times where hedges can be cheap? How do you play that game a little bit as an investor? What are some ways to think about that?
Well, so kind of a good kind of a rule of thumb is you can look at something like uh, the VIX futures curve, and it's a lot like an interest rate curve, and it's got this normal sort of a shape. It's up and to the right, and that shape really is embodying that as you go out further in time, there's more risk. So interest rates are higher as you go typically as you go further out in time because there's more risk. Same with the VIX futures. And so in a normal environment, you see that shape, and you can take advantage of that by say going short long dated VIX futures and watching them decline in value as you come in closer to maturity and risk and concerns mitigate. But there are times when you've got, just like with the interest rate curves, you've got the opposite effect where you've got a high current rate and the curve actually goes down to the right because there's less risk, less future, less concern as you go further out in time. And so that's really kind of a point where you want to try and be long VIX futures. So generally, you'd like to be short VIX futures when you've got that kind of normal shape, when the VIX future curve is up and to the right, and you want to try and be long them when it's the opposite shape, when it's down to the right.
At times, instead of using a VIX curve or S&P futures, to use particular companies or stock entities as a representation of that, or is that fraught with concerns that might not be reflective of volatility per se, but something else?
Yeah, there are strategies that do that, John. We don't do that. We like to try and isolate out the idiosyncratic risk, and we see that the reason we like to play with this variation between the relationship between the VIX and the S&P is that the S&P has the fourth least volatility per measure of return of any of the major asset classes. And so that's a good one for us to work with and off play the relationship with the VIX. There are specific assets that you can use to try and do the same thing. But they tend to just be more volatile and a lot harder to deal with that relationship. I mean, you look at a stock like, say, a Google or an Amazon or an Apple or something. Those can be great stocks, and there can be a lot of opportunities in those options. But you wind up in a situation where, maybe you've got an Enron, and they're accused of fraud, and that particular asset can decline dramatically, where the market's not really affected. So you really can't play a broad market volatility asset off against an isolated asset class like a stock.
Let me ask my last question then, because it looks like we've got a lot of muted volatility, or at least volatility has been low here. Like, is there a danger of it staying low for too long? I mean, obviously something can only stay as it is for so long before it pops or something like that. Is there any danger here of it staying low for too long and thus, put us in a position where it's going to spike and hurt us? Or do you think it could just stay low until it stays low and there's no big deal whatsoever?
It can stay low for a long time. It reminds me of the saying, the market could be wrong for a long time, longer than an investor can finance their correct assessment of the market. But we like it actually when volatility is low, because we tend to get that normalized volatility curve that I spoke about. So it's a great opportunity for us to be selling those short dated VIX futures and just watch them decline in value as they approach the spot VIX index price. And at the same time, it's a great time for us to hedge that position, so we can go out and buy VIX calls to protect against a situation where there is some anomaly in the market and the VIX spikes spontaneously in a very short period of time. We're not flat-footed. We've got some good protection there, and we can actually, if we do it right, we can actually make money on that long call position while not losing too much on the short VIX futures position. So we actually like it. We got down to, as you probably saw, I think it was about 11.8 on the spot VIX index. That's a great level for us. We like that a lot.
Volatility, it's an asset class. I think it's an asset class that isn't brought up very often because, like you said, it's a little complicated. What does that curve really look like? How to access it? I think a lot of managers will just apply this reasoning or rationale to stocks. You have a different way of looking at it. And as a result, you've had a long and successful career. So I think there's lots of ways to do this. Yours is a different one. Well, thanks, Russ. This is great. Volatility is so interesting these days because, like you said, it's muted, but then all of a sudden it can boom, kabang really quickly. And if you're not prepared, boy, it could put you in damage, can it?
I think that's right. And again, I think it's a huge asset class. I think it's a very underappreciated, very underexamined asset class, which I think opens it up to some unique opportunities versus some of these asset classes that are really kind of overtrod, overcovered, hard to find interesting opportunities in.
Great. Appreciate you giving us some clarity in a complicated spot. Find this on the blog. We'll send it out to others too, but stay tuned. We're probably going to come back to you for more because things always change and you've got a good pulse on this stuff. So appreciate it. Have a Merry Christmas and we'll talk to you again soon.
That's great. Thanks, John. Happy holidays to you also.